Over a single fiscal year, Arit's net income expanded from 59.7 million to 346.8 million shekels. This performance, driven by its subsidiary, Wachef Technologies, marks a transition into a new phase of operational scale for the company. This is the consolidated income statement. As shown on the top row, revenue climbed from 126.5 million to 523.8 million shekels, a 4.1-fold increase. 60% of that sales volume was generated outside of Israel. This geographic shift indicates that the recent growth is driven by a structural expansion in global earning power, rather than a temporary regional demand spike. The standout metric in the 2025 report is the gross margin, which expanded by 1,300 basis points to reach 69%. For a heavy manufacturing business to achieve these margins, the unit economics must be highly optimized. As production volume quadrupled, the company's fixed overhead costs remained flat. That widening delta directly translates into the observed margin expansion. This efficiency flowed down the P&L, resulting in an operating profit of 322.7 million shekels, a 5.5-fold increase over the previous year. Hardware manufacturers rarely reach 69% margins without extreme operational leverage and optimized economies of scale. Assessing the quality of these reported profits requires a look at cash conversion. Operating cash flow reached 377.2 million shekels, up from 126.6 million in the prior period. Because the current scale requires relatively low capital expenditure, the company's ability to convert profit into liquid cash is exceptionally high. The balance sheet confirms these reserves. Arit holds an equity base of 1.054 billion shekels, heavily concentrated in unlinked cash and financial assets. This cash pile provides significant downside protection and arms the firm with dry powder for internal expansion or acquisitions. Protecting these margins requires an operational moat to defend against global competitors. The baseline advantage is built on battle-proven technology and a rapid timeline from research and development to active deployment. In 2025, Arit deepened this moat through the vertical integration of a proprietary power source. This excerpt describes successful firing tests for a proprietary battery, a component currently facing a global shortage. Internalizing this production mitigates reliance on foreign supply chains and insulates the company from geopolitical bottlenecks. This vertical integration establishes a standalone product line with independent revenue potential, specifically targeting the Indian market. Vertical integration supports the broader strategy of geographic risk mitigation. Arit is establishing wholly owned subsidiaries directly within key foreign markets to bypass defense import barriers. These entities, Flash Fuses USA and Wachef Technologies India, allow the firm to operate as a local player. This table from the financial notes verifies the 100% ownership stakes in both the US and Indian subsidiaries. By manufacturing locally, Arit transforms from an external vendor into a preferred domestic supplier for foreign government contracts. A complete investment thesis must also evaluate the specific risks that could interrupt this growth. Section 39 details the primary macroeconomic risk: reliance on raw material imports and export pathways centralized in Israel. A strict embargo could immediately restrict the supply of subcomponents required for final assembly. There is also the microeconomic risk of client concentration. The current revenue base is heavily dependent on a limited number of anchor projects. While the financial upside is significant, a prolonged geopolitical trade restriction or the loss of a major project would break the bull thesis. Future valuation is tied to specific forward-looking catalysts beyond the 2025 performance. For the first half of 2026, the company is targeting the launch of electronic fuses specifically designed for loitering munitions. Capturing growth in modern, drone-centric warfare requires this adaptation to loitering platforms. Success in this niche moved Arit into one of the defense sector's highest growth addressable markets. We can plot these strategic execution milestones over the next 24 months. By the second quarter of 2026, the company expects to secure U.S. manufacturing licenses, unlocking access to long-term Department of Defense contracts. In 2027, the firm anticipates an expansion of the Indian multi-year contract, supported by standalone sales of the proprietary battery. Arit has utilized the current global defense spending environment to rebuild its margin profile. The company now operates with 69% gross margins and a billion-shekel balance sheet. Arit has shifted its identity from a local contractor to a structurally entrenched, cash-rich global player positioned for long-term yields.